Thank you for joining us at XM.com. This is the week ahead, and it will be a big week for the dollar and the pound with important data releases from the United States and the United Kingdom. I'm Christina Marujas. With me today is our lead investment analyst, Rafi Boyajian. So, Rafi, starting with the United States, market speculation has risen for a June rate cut by the Fed, especially after Powell's speech before Congress, which in turn, of course, hurt the dollar. Now, if this week's CPI and retail sales data point to a resilient U.S. economy, how could that affect market expectations regarding the first rate cut?
Well, Christina, of course, that is a very good question because we have been getting somewhat hotter than expected data. Most recently, the data was somewhat on the soft side, notably the ISM PMIs. But when it comes to the CPI reports, the last two came in stronger than expected. So hopefully we're not going to get another surprise this time right because, of course, as you mentioned, after Powell's remarks before Congress, there is hope that the Fed is still on track to cut rates by June. Now, the thing to consider here, of course, is that the Fed is still kind of avoiding being very specific in terms of the time frame for a rate cut. So that suggests that there's still some concern about inflation not falling fast enough. So they're not yet committed to a particular time frame, but markets are pinning their hopes on June. So should we get stronger than expected CPI numbers on Tuesday, for sure that could set off a negative reaction in the markets. And I think the problem with the CPI report is that based on the forecast, it's probably going to be a bit of a mixed bag. Headline number is expected to remain unchanged at 3.1% due to a slight pickup in the month-on-month rate. The core figure, though, is expected to come down a little bit to 3.7%, having been stuck near 4% for some time. So overall, maybe the CPI report might not tell us too much, but as long as it doesn't ruin the optimism that the Fed is on track to cut rates in June, that should be taken positively by the markets. But let's not forget, of course, we're also going to get the retail sales numbers on Thursday, and that will be important because we have seen a bit of a slump in retail spending in January. Overall, it appears that January wasn't a very strong month for the US economy. So, of course, on the one hand, strong data is, if you like, bad for the markets. The markets, neither do they want anything too weak data, because what's kind of keeping the markets going at the moment is this soft landing narrative. So as long as there's a decent rebound in retail sales, that should please the markets, and it might support the dollar in the instance that we get perhaps a weaker than expected CPI report.
Now let's cross into the United Kingdom. We had the budget announcement a few days ago, which included measures to boost sluggish growth. Now, GDP and jobs data are coming up this week. What could these reports mean for the pound?
So the UK is in a technical recession right now. Of course, we shouldn't read too much into this because GDP numbers do get revised. So there's a bit of a focus on the monthly GDP prints, which will probably tell us that the UK economy did grow slightly in January, and perhaps that would be a sign that the UK is emerging out of its technical recession. But of course, the jobs data will be watched too, particularly when it comes to the wage growth numbers. Now, there's been a bit of an issue with UK employment numbers. And in actual fact, the Office for National Statistics has admitted that its respondents rate has fallen. So the employment change numbers might not be too reliable lately, but wage growth at least is something worth watching. And of course, we know that the Bank of England is paying close attention to the wage numbers because that's really kind of the main constraint in terms of how soon the Bank of England will be able to cut rates. So that's going to be important too. But as far as sterling is concerned, I think the main thing at the moment is it's gaining on the back of the weaker dollar. Investors are still fairly pessimistic when it comes to the UK economic outlook. So it's really down to the fact that the Bank of England probably won't be able to cut rates at the same time as the Fed or the ECB. They might be one of the last ones to begin cutting rates later this year. So that is supporting the pound. But of course, we do have the Bank of England meeting coming up later in the month. So I think these numbers will potentially help give us some indication as to what to expect.
Rafi, thanks so much. This was the week ahead here at xm.com.